Hello, I'll take these off. Welcome to the sharpening session for today. Now, for those of you that have never joined a sharpening session before, what the point of these sessions are, usually held over the weekend, is that we are looking at more theoretical things as opposed to actively trading in the markets. Most markets are obviously closed over the weekend. So this is to help fill in knowledge gaps, give you guys some extra information, methodology, things like that. If you have specific things that you would like to be covered in these sessions, just email me, becky@tradewithufos.com. Let me know what you would like to be covered, and I will make sure that we cover them. For today, we're going to cover back testing. Before we do that, let me just put on the disclaimers in the top left-hand side. Please read them. They're obviously there for legal purposes, of course, but also for you guys to understand what you can expect from these videos. In a nutshell, just because we trade in a certain way or we do things in a certain way does not mean that applies to everybody or that everybody should do that. Now, what we go through today will actually help that to make a little bit more sense. As far as I'm concerned, every trader should be trading slightly differently from each other. Even if they use the same methodology, the application will change and will vary. That's to do with your trade plan. Back testing is something that helps to confirm or not what you should be doing in your trade plan. So what we go through today kind of helps back up this disclaimer anyway, but just so you guys are aware of that. Okay, so you've got my email address there, becky@tradewithufos.com. There's also, if I put this on the screen, tradewithufos.com/Becky, which I don't actually think that I have loaded. So let's have a look. Put it on here. tradewithufos.com/Becky. This will take you to this page here. From this page, there's different help and resources, some of which are paid for, some of which are free. It obviously depends. Have a look at what it is that you need and what you're looking for. Now, you can check out our apps, again, some of which are free, some of which are paid. Our courses, those are paid for, reasonably cheap. Coaching, which is group coaching, accessing these kind of videos in a more, you access them live instead of recorded, and you get extra resources as well. You can also book one-on-one coaching with me as well, different login areas. If you scroll down, you'll also see there's this area here, which is where I log all of the trades that I place in these sessions that I do. So stocks, Forex, and crypto, these are the trades that I'm placing in those sessions. And you can see, why might they be cancelled? Profit, losses, small loss, small profit. What does that mean? What does that equate to? You can check out the snapshots of it and some notes so that you can figure out what's happening, why we might manage trades in certain ways and learn from this area. That's all posted on there for free. And if you scroll down, more information about our apps, again, depending monthly, yearly, or whatever platform you're using, more information on our platform, which I'll be using later on today, and a question and answer section as well, which you can post your question here. We will answer it here, or you may find if you scroll through and back through the different pages, other people have already asked the question that you have, in which case the answer should already be there. Okay, so that's all the places you can go for support and resources. You can email, you've got this link. You can email support@tradewithufos.com as well. Lots of places that you can go if you need help, and we are here to help you. So back testing, let's come back to this. So let's come back to our PowerPoint for now. So back testing, what we'll go through today, and I'll put these all on the screen first, is what is it? This might be the first time you've heard the concept, or you might have heard it before and you might have no idea what that actually means. So what is back testing? We'll look at that. Why is it useful? Why would you do it? Why is it more useful than not doing it? Which markets does backtesting apply to? Where can you backtest? What can you backtest? And what technology can we use to backtest? So let's roll back to what is backtesting. Now, again, you'll see at the bottom here, you've got that link, tradewithufos.com/Becky. Just behind that, you should just about see my email address, becky@tradewithufos.com. If, as I explain things in today's session, it is too quick and you get lost and you don't really know what I mean, or you want me to clarify anything, please do email me. I'm happy to help. Now, by the way, I've just seen that as I see on the scroll down. You'll also see this ticker at the bottom, which is quite exciting. For those of you that trade Forex or are interested in Forex, everything we know about Forex and all of our methodology and risk management techniques are all in our recent book, which has been released. It's only $3.88 at the moment as an ebook. It's more, sort of 4 times more, I think, if you get it as a paperback. But as an ebook, relatively cheap. It's got all of our information in there, and you even get free access to our Forex course if you get that book. So if you're currently thinking about taking the Forex course or getting involved in the Forex markets, or you are involved in the Forex markets, that book is going to really help you, having something that you can refer to as you go. Okay, that aside, what is backtesting? Backtesting is looking into the past, using the data that we have for basically every market. So I'm answering one of those further questions as well. Using the data that we have from the past to figure out, if I'd have been using this strategy, whatever strategy it is, whether it's our methodology that we teach, whether it's a completely different one, a blend of those things, whatever it is, if I were to be applying this strategy for the past 5 years, 5 months, 1 year, 10 years, however long you want to go back, if I'd have been doing this strategy for the past few years, say, what would have happened? Would I have been profitable? Would I have lost? If I'd have been profitable, what could I have done to make that more profitable? What if I'd done that instead? What if I'd have done that instead? If I lost, then what could I have done to maybe make it profitable? Or what have I learned from that? So backtesting is applying your methodology, whichever one you're using, applying your strategy to past data. Now, why is that useful? It's useful because the data's already there. If you are applying your strategy now, and let's say it's worse for investing, definitely takes longer, but even if you're a day trader, and so every day maybe you have 1 or 2 trades, if you want to learn over the course of 100 trades, is my strategy working or not, then you might need 100 trading days, which would be 25 months, before you learn if your strategy is working or not, or what could make it better. You have to wait for real time to pass. If you are a swing trader and you're placing 1 or 2 trades a week and you want 100 trades worth to learn something from, to improve or to test whether or not your theory actually works, then you're waiting a year, 2 years to learn a lesson. You're waiting for time to pass because you don't know ahead of time what the result of your current trades will be. If you could, that would be great. You'd obviously always win if that were true. So backtesting is useful because I can run 5 years worth of analytics, 5 years worth of data, get 5 years worth of trades in maybe a matter of weeks. I could get 100 trades worth, 5 months worth of data, again, in maybe a matter of weeks. Whether you're day trading right the way up to investing even more so in terms of saving time. If you're investing and you have, call it a trade a month, or less than, let's make it nice and easy, 10 trades in a year, 10 transactions in a year, which even then might be still a lot for investors, then it's going to take you 10 years before you get 100 trades worth to prove your point or not, or to see or learn how you could do better, how you could manage your risk better, how you could maximize your profits, how you could increase your probability. It's going to take you 10 years to get that information. Or you can go back 10 years from now into the past and collect that same amount of data. Now, the common question I get when I teach backtesting is, just because it worked before, does that mean it's going to work in the future? The answer is no. That's true of everything. Everything in the world. We only ever have data up until now, the current moment. Nobody knows what will happen in future. We can use all of the data that we've accumulated in any subject you want to talk about in the world to give accurate predictions. But even then, it's not going to be 100% accurate. So you're never going to be able to predict the future. But why would you wait for months or years to gather information about a strategy and test in the real world, in the real markets, if it works, when you could test in the real world in the markets that's already happened? Test your theory. I'd also say, if you had been, let's take a random time period here of 2 years, making that up. If you had been trading a strategy for 2 years and it had been working and you'd been consistently profitable, would you be worried now that it's suddenly not going to work? If you'd been day trading day in, day out for 3 months, 6 months, a year, and you'd been profitable every week up until now, would you be stressing about the fact that your strategy might all of a sudden not work? So save yourself the time of actually going through that period of time to get the data and use what we already have, the data that's already there. Apply it to the past, learn the same lessons, make the same mistakes, but in an environment where it takes you a lot less time and zero money to learn that lesson. If you are implementing a strategy now to test it or to try different variations, you might do it on a demo account, in which case, again, zero money. You're not risking dollars, pounds, euros, whatever, to learn, but it's taking you time. Also, if you are applying it maybe with a smaller account or the same account, then you are risking money to test whether or not your theory works. Now, I would say, considering we teach different applications in different markets, right? Or we teach the same methodology and how it applies to different markets. I would say we fit into this category same as anybody else. Learning a methodology from somebody else and simply copying it exactly without backtesting is not the best idea. And the reason for that, if we think about ourselves as business people, and I always use this example, if you are going to buy a McDonald's franchise, if you are in the center of Ho Chi Minh City in Vietnam, or you are in the suburbs of a town near Washington, D.C., or you are in an industrial estate in somewhere in France, will your business work slightly differently? Hopefully the answer there is yes, right? The McDonald's franchise, even if you've bought McDonald's, they've got a methodology, they've got a central system that works. It will be applied slightly differently depending on the environment. If you've got a McDonald's that's over 3 floors and it's huge, then the amount of employees you have is going to be different than if you have a small McDonald's kiosk that can only fit 2 people in. Or if you have, I don't know, if you're in a certain part of the world, you're going to charge different amounts of money. You might alter the menu slightly. Still McDonald's, still the same root, the same core, different application. This is the mistake that traders make all the time. They might learn on YouTube for free. They might buy courses, buy books, whatever they're doing, learn a methodology, and they just go and implement it straight away, immediately. But you, as an individual, your business will have a slightly different environment than somebody else. For example, me personally, my lifestyle, the way I live, means that I can't be too consistent in the time of day that I sit down to trade. Because I do various things, I do various calls, I travel a lot. My wife's from Mexico, I'm flying back and forth to Mexico. I cannot guarantee that I can always be sat at the computer at an exact time every day, or even an exact day every week, in order to consistently execute my trading plan. So my trading plan has to fit around me. I'm much more likely to position trade, which is what I do, when my trades last ages. And it doesn't matter specifically what time of day I sit down, because I'm using way bigger time frames. My trades are lasting way longer. If I were a day trader, I'd have to be way more specific about the time of day that I sit down to do it and which days I do it on. So I'm a different environment than somebody that has a different life. Equally, somebody that has millions of dollars in their account will be trading differently than somebody that has $100 in their account. It's all relative. It depends on your individual bubble, your individual business. You might apply pretty much the same methodology, but you might want to test it on different timeframes, on different markets. I tend to trade stocks and Forex and cryptocurrencies. I used to trade futures when I was younger, but I had more time to day trade it. Since I can't really day trade anymore, I don't really trade futures anymore, personally. Not to say that you can't swing trade futures, you can. But just to say for me, futures and day trading worked well together. I can't day trade, so I don't trade futures. Other people might be able to trade futures and options. Nothing to do with what I'm trading. Same methodology, different application, different markets, different time frames, and also different risk tolerances, different processes that our brains go through. Some people might want to have, I hope that this doesn't freeze my screen because sometimes this happens, but we'll see. Some people might want to have, let's say, 100 trades in a year, 50 of them be right, and when they're right, they make 2, and when they're wrong, let's change the color of this, they lose 1. So overall, if half of them are right, 50 of them, if we do this here, 50 times plus 2 equals 100. The other 50 times minus 1 is minus 50. So overall, they make 50. Okay? They're profitable by 50. That could be 50%, $50, $50,000, $50 million, whatever you want. Put it relative to what your situation would be. Some people might prefer that situation. Other people might prefer that out of 100 trades, it can only be right on 20 of them. Only make money on 20 of them. And you might think, why would you do that? If you could be right 50 times out of 100, why would you do something where you're only right 20 times out of 100? Because maybe some people prefer, I might be right less often, but when I'm right, I make 6. And when I'm wrong, I lose 1. And so here, so they've got 20 times 6, which would be 120. I think, yes, 120 times, yeah. Over here would be 80 times minus 1, so minus 80. Overall, they're plus 40. Okay. So they were right less than half the time, but they made 80% of the profit still. Change that to 7. They're making more money than these guys, even though they're wrong more often or right less often. Neither of those are right or wrong. Neither of those are what you should or shouldn't do. They apply to you. Are you okay being wrong 8 times out of 10? Are you comfortable with that? Some people will say yes. Most people will say no. Are you okay to make less money each time you're right in exchange for being right more often? Yeah, some people will say that. Other people, no, I'd rather make as much as I can each time I'm right. And if that means I'm right less often, that's okay too. So again, kind of going off a little tangent here, but this will be the kind of things you need to think about when you're creating your trade plan. The methodology might be something that you say, okay, great foundation. How can I tweak this to fit me? Where I can be right more often, even if that means that I lower what I make when I'm right. Or can I increase what I make when I'm right, even if that means I have to lower this? Or even better, how do I balance those two things in the right way for me? We're all going to have a different number, a different balance of that. It's going to do with how patient we are, our human qualities, right? Our patience, our risk tolerance, how much we freak out, right? Our emotions. I'm personally not comfortable being wrong 8 times out of 10. I don't like that. I'd rather be right more often because I don't like the feeling of losing that many times in a row. So I'm a human being. If you were a robot, you'd pick whichever one gave you the best number at the end. But that's not how humans work. And we need to have a trade plan that suits us as individuals and that can be applied in a way where we are able, as humans, to consistently execute it. I would not be consistently executing a trade plan that made me lose 8 times out of 10, even if when I'm right, I make way more than what I lose when I'm wrong. Me personally. Other people say, I don't care, I'll lose 20 times in a row. I don't care. I lose 20 times in a row if it means that when I'm right, I make 30. Okay, cool, good for you. It's not something I would do. Each to their own in that sense. Your trade plan should be your own. You are a different environment. You are a different McDonald's franchise, if you want to think about it that way. Therefore, your trade plan, your execution of your trade plan should be different than other people. How does this relate to backtesting? Backtesting allows us to test those variations, to make these tweaks, to learn what can work for us and what can't work for us, to learn how we can play about with those numbers in way less time than real time waiting for it to happen in real life, and in zero money, because the trade's already happened. It would be great if we could go back in time and place the trade of our lives. We can't do that. We can only see what's happened and learn from what's happened. If I'd have done this every day, what would my result be? If I'd have done this and maybe tweaked that, what would that have done to my result? Oh, great, that's made it more profitable. I'm going to use that. Oh, actually, that made it lose more. Don't do that. And we learn in that environment. That's why backtesting is useful. Okay. By the way, I'm just going to check the chat box for those that might be here live. I know most people watch these recorded, so I'll keep an eye. If you are there live with me, please let me know. If not, as I said, take that email address, which you can just see, I think, becky@tradewithufos.com. Let me know if you have questions. Okay, so which markets does backtesting apply to? Kind of a trick question because it's every single one of them. Options is harder to backtest. Now, I don't trade options. I'm not an expert on options. I can't really give you examples on those things. I can with futures, stocks, Forex, and cryptos, but options is just not my thing yet. I would like to get into it in time. Options is harder because of the decay of because of the decay of the value of the option and of certain strategies that you can do that take into account the time and the decay. That's not just about price movement. That's harder to backtest because it changes more often in real life. Now, in terms of how it applies to options, if you're an options trader, I would advise you to watch Jose's sessions and Joseph's sessions. If you can attend live, even better, because you can ask them in those sessions, how would I backtest this? If that's what you want to learn. If you trade anything else, stocks, Forex, futures, crypto, it works pretty much the same across any of those markets, and I will show you today. So it applies to everything, options slightly harder, but everything else pretty straightforward actually. What technology can I use to backtest? There are lots of platforms that allow you to backtest. For those of you that are within our community, you're likely using maybe TradeStation, and you can do it on TradeStation. I won't show you that today. You can use TradingView, which is a free platform to use, and the backtesting capabilities are for free. So I'll show you TradingView today. And you might be using Top, which is our platform. I'll show you how to use it on Top. There are other platforms that you can use to backtest with, some better than others. The good thing about TradingView and Top is that it's, in my opinion, both very easy to use. TradeStation too, very easy to use to be able to go back to a certain place in time. Now, in my opinion, TradingView and Top are, from what I've experienced, two of the best ones to be able to do this on. Again, Top is our platform, which you have to pay to use, but TradingView is a free platform. So I'll show you both. So I'll show you two different platforms. I'll show you multiple different markets and show you what backtesting looks like, how you might do it. Now, for those of you where backtesting is a completely foreign idea, you've never heard of that before, you don't know what it is, This bit might now be a little bit over your head as I'm showing you on the platform what it looks like. If you have questions, let me know. There's also, and again, it depends on what people want to do, but there is a course on this, which if you go to tradewithufos.com/Becky and go to courses, and I do this course, which is on here. So I've got a backtesting course. You can get it on demand for $34. Included with that, you get a month's worth of UFOs for free as well. And UFOs start at, I think, $55 a month now. So again, kind of a discount here. To learn more about backtesting in much more granular detail before you start applying it. If you're with me right now and you get what I'm saying and you understand what it means and you want to be shown what it looks like on a chart and you're used to using charts and you know what it looks like, then no need, right? You can just follow this. So it depends where you're at in your knowledge and your experience and your comfort level as to the level of support or the level of knowledge or extra knowledge that you might need. So if I've lost you, don't worry, is my point. There's always going to be a way around it. If I haven't lost you, stay with me and we'll carry on. Okay, so let's have a look. This is a stock. I'm using Apple because it's obviously a very well-known stock. I'm going to use swing trading or position trading timeframes. Although, in fact, actually, let me use position trading timeframes on stocks. And when we look at other markets, then we'll use different timeframes as well. Just to show you, again, it applies across the board. Same thing, same application of the same technology. You're just going to apply it to the markets you trade or the timeframes you trade them on. So I have a weekly chart on the left. I have a 144 on the right. Again, those are the preferred timeframes we use. You pick whatever timeframes you want. Again, one of the things you might choose to test is timeframes. Does it work better if I use a 144 or a daily chart or a 4-hour chart or a 2-hour chart, whatever? There's literally millions of variables that you could put together all in different ways. Backtesting should be something where I would say you shouldn't be testing more than 1 or 2 variables at a time. Otherwise, you will need thousands and thousands and thousands of trades in order to get all of the combinations of those variables to prove a point or not. Stick with a methodology that you have. You might have one already. It might be our methodology that we teach and that we use, that you see us use. Might be something else entirely, but pick one, have a strategy. And then you might say, what if I applied the exact same strategy, but to a different time frame on the right-hand side? What would that look like? Would that give me better results or worse results? Better results? Great. And then you might say from there, what if I use that time frame and I use a different indicator as well? What does that do? Does that make my results better or worse? Oh, it makes it worse. Okay, take that out. What about a different indicator? Oh, that works. Great. Keep it in. So over time, you are building a sturdier and sturdier and sturdier plan. This should be a better word than plan. Strategy that you've proven in real data from real life that just happened in the past. The same as if you'd been trading it yourself for that period of time and learning those same lessons. So I'm just going to, I have a radiator on in this room. It's very, very hot and it's distracting me. So I'm going to be 2 seconds and I'll turn the radiator off and then I'm going to come back and show you how this applies. Okay, sorry about that. So we have weekly chart on the left, 144 on the right. Those of you that know our methodology know that we would be using AutoClimate, which is this app here, to help us decide whether or not to buy or sell. And we would be using the right-hand side to choose a specific UFO to buy or sell at using those numbers, providing that it coincides with our EMA price from the left-hand side. If I lost you there, watch any of our sessions on YouTube. Forex, stocks, options, again, slightly different, but futures, same thing. So you'll be able to pick up on what that means. Okay, so at the top of the screen, or again, it might be on a different, depending on which version you use, what browser you're on. Might not be exactly where you see mine, might be down the side somewhere, but it's those two little rewind, or those two little triangles that show you a rewind symbol, and it's called bar replay or replay. If I click on that, you'll then notice that we've got this line that appears, and it will apply to the chart that I'm clicking on at the time. So if I get out of this now and show you, if I'm on this chart, and you can tell that I'm on this chart because I've got this blue box around it, this light blue line around it. If I'm on this chart and I click replay, but I want to do it on this, the line won't be there. Because as far as TradingView is concerned, you want to backtest on this one, not on this one. So if you notice that that happens and it's not on the chart you want, just click the X down here. So you've got this little toolbar that appears once you click the replay button. Got a little toolbar that appears. I'll show you what that looks like in a minute, or how that works. You've got a little cross. You can exit that. Click on the chart that you want to use it on. Click replay again, and then you'll notice that that line applies to the chart you want, and would not apply to the chart you don't want. Okay, so I'm going to start with the weekly because I think that makes sense to do. And we're going to assume, if we're on these kind of time frames, that we might want a year's worth of data. Now, I would say absolute bare minimum 30 trades. 30 trades to me, I would never backtest something for 30 trades, put it that way. For me, absolute bare minimum is 100. Statistically speaking, 30 is enough for you to start getting an idea, but I would say bare minimum 100 trades. I've done backtests where I've done thousands of trades over years and years to help me learn and prove points and test different strategies. So minimum 100, really. If you have to be lazy, then 30 would be the scraping the barrel at the bottom, absolute minimum. But let's say we want a year's worth, and maybe we're applying it to different stocks. So we're going to go back a year. So today is what date is it? 22nd of October. So we'll go back to the 22nd of October, 2021, which is actually here. Not too far back on here. So you see here, so we've got the week of, remember this is a weekly chart. So the week of the 18th, so if it starts on the Monday, 18th, 19th, 20th, 21st, 22nd. So the 22nd of October would be a Friday in that case. So we go back to that week, the week that starts the 18th. All I do, I click replay. I have this line and I come and highlight. I find that Monday, the 18th of October, and I click on that line. And it's cut all of that data to the right-hand side. I now don't know what happened to Apple because this is showing me what I would have seen. In this case, it's actually the end of the previous week. So if I were to look at this on Monday morning before the markets opened, this is what I would see. So you're essentially going back in time. You're going back to see exactly what you would have seen at that moment in time, which is pretty cool, I think. And something that in trading, we're actually quite blessed with. Because in real business, you can't go back in time, in most cases, and look at everything and all of your variables exactly as they were at the time and play out different strategies to see what would have happened. In trading, we can do that. We can go back to an exact time, to the minute, and look at what we would have looked at then and analyze our variables exactly as we would have then, and then play it out and see what happens. So if I was looking this on Monday morning before the markets open, this is what I see on my weekly chart. Now let's assume I'm using a 144. I'm going to do the same thing. Now, because it's a smaller time frame, it's going to be more candles, obviously, that make up that area. So we'll go back to roughly that area here. And I'm going to click. I'm already on replay. So see this button here? It's like an arrow that's pointing towards a candle. If you hover over it, it says jump to. I'm highlighting what's on the right here. It's got a blue box around it. I'm just going to click that. And I'm going to go back in time to the week of the 18th. So, just there. So this is my time. No, just before the market. So now I'm looking almost exactly. There's going to be a slight discrepancy because the data on the left is telling me what happened on the weekly candle. This is telling me what's happening on the 144 candle, which means they might not always exactly sync to give me the right price, but it's off by a cent. So it's pretty much exactly what I would have seen then. I can now look at this and analyze it as if it were that day. So let's say in real life, I look at this chart, I would go, auto climate is unconfirmed, nothing to do. I'd then have to wait a whole day for the next candle. A whole day, 24 hours has passed. I look at it again, nothing to do. I wait again. Now on the next day, we're now looking at what I would have seen at the close of play on the 19th of October last year. Still unconfirmed, nothing to do. Wednesday, unconfirmed, nothing to do. Thursday, unconfirmed, nothing to do. Friday, unconfirmed, nothing to do. An entire week of real life would have passed for me to learn that there was nothing to do that week. That took seconds to figure that out. Next candle, brilliant. Okay, so on Monday, the 25th of October 2021, we had a thick blue dot on our auto climate. We also had buyers underneath us there. Okay, great. So let's find that place on the right-hand side as well and see what we would have seen. Now, there are different ways we can do this. We can come out of bar replay on this chart and then find it again. We can click this button here, forward. Each time we click it, a new candle appears. So we can control how the candles are appearing on the chart. By clicking at it, each time we click, a new candle appears. It's filling in the gaps between that time and now. So I can keep doing that, and I want to find Monday the 25th. So I'm here now. Or what I could have done, and I'll show you that in a second, is click this one and have it play out for me without me needing to click it through, and then pause it when it gets to the right time. But let's assume we're on this. So let's just go back. So this is showing me close of play now. Monday the 25th of October, what I would have seen close of play. Likely that we would have seen a thick blue dot on the morning anyway. So thick blue dot, probability is upwards. Our EMA is 146.54. Does that coincide with a UFO on this time frame? No, it does not. So nothing to do. So perhaps throughout the day, did something else appear? Nope, nothing's there. We're now on Tuesday on the right. So now we'll just play that out. We're on Tuesday on the left. And again, we've got our EMA at 146.68. Does that coincide with the UFO? No. So again, we keep playing that out. And we would have seen just there, if I just jump back, click through a bit quickly. Could have sworn I saw a UFO appear, but maybe not. Okay, so you keep going in theory. Here we go. So price jumped down here, and this would have been on the Friday. So we were currently on the Tuesday then. So we go Wednesday, Thursday, Friday. So EMA is at 146.77. Again, not aligning with our UFOs. So again, keep playing it out. And in real life, we started on the, what was it, the 18th of October. We are now looking at the 2nd of November. A couple of weeks have gone by in this world. In real life, you'd have to wait 2 whole real weeks for nothing to have happened. So again, you just keep playing it out until you see something that aligns. Now, unfortunately, I don't know when in history something did align. Hopefully, in the different examples we look at, we can find something. But the point is that in real life, you'd have to go back through, in real life, you would have to place trades, wait, cancel trades, wait, look at a market, have a look, realize there's nothing to do, wait. For days, weeks, months, before you learn anything. We've just gone through 2 weeks in 2-3 minutes. You see the power of this, the efficiency of this to do the same thing. So this is stocks and this is TradingView. What I'm now going to do is look at top, and we'll look at, I mean, we could look at FOREX here. Probably should have done it the other way around, but let's do this. Let's assume you're looking at FOREX and you're looking at a daily and a 55-minute. So here we go. Similar thing here. So I've clicked here on the left-hand side. Just trying to find my... Should be here. I had it here earlier. Can't find it. Got it on the right-hand side, but I obviously want it on my left-hand side. Should be here. Let me... Oh, brilliant. Found it. Okay, good. So let's say we are on smaller time frames. So let's say we go back 6 months. So that would be, call it mid-March, start of March. Let's go to the start of March. So again, I would just squidge it. Go find start of March. Click here. So you're going to have a rewind. Again, this says training mode. So again, we're training ourselves. We're learning. It's got the rewind symbol. Same symbol as we saw in TradingView, just in a different place. So I lost it for a second there. I couldn't see it on this chart. So all I did is I right-clicked and I clicked line toolbar and it came up. So I've now got that image, or that symbol on my left-hand side chart, and I've got it here as well on my right-hand side chart. I'm going to do the same thing. So I'm going to click that area. You'll now see that I've got a crosshair here, and I can go back to start of March. So 3/1, as Americans would see it. And there we go. I'm looking at what I would have seen on the 3rd of March, sorry, on the 1st of March, 2022. I do the exact same on my right-hand side. And if it doesn't load the amount of data, then I can go to format. I think it's format. Load 500 bars. We could put 1,000 bars. A while to load it there, but let's say I'm just going to go back to September here. Should load those bars. It's just taking a while. There you go. Brilliant. So that's September. We're going to come back to March again to do the exact same thing we just did. June, May, April, March. Lovely. So 1st of March, and you'll see, by the way, on the left-hand side, as I scroll on the right-hand side, you'll see the left-hand side will show me as well where it's aligning. But we want here the 1st of March. So I'm going to click this little button, the rewind symbol, the rewind button. And I'm going to go back to the 1st of March as the candle opened, or even better, the time of day that I might sit down. So let's assume you're sitting down at 8:30. Okay, so it's a 55-minute chart. So let's look at the 8:35 candle. Ooh. Lovely. Okay, so again, now I am looking at exactly what I would have looked at if it was the 1st of March earlier on this year. And I do the exact same thing. I'd go, what does AutoClimate tell me? Thick red dot. Probability was down that day, so I'd be looking to sell. The EMA is 1.1251, which is somewhere here, not lining up for now. And all I do to skip forward, same as I did on the last one, just going to hover over this. It says forward. I'll click it. Each time I click it, a new candle appears. If I wanted to play it out, so I don't have to click for the candles to appear, I just click play. And that is now automatically, I'm not touching anything, it is now automatically generating those candles. And to pause it and stop it, I just click pause. So here I am, I'm now looking at the 1st of March at the end of the day. And our EMA is way out of where our candle is. So perhaps that day there was nothing to do. The day after that, which is the 2nd of March, just skip forward a couple of bits. Brilliant. We're on the 2nd of March now. Maybe again, you go to look at the time that you would have looked at it. There you go. Similar kind of time. And you go, okay, the EMA is at 1.1226. 1.1226. That's within this UFO. So let's assume that that's a trade you would place. All you do is you do exactly what you should be doing now as you're placing trades. You might draw lines around it. You log it somewhere. So let's say, let me bring up a completely random empty Excel just to show you what you do. Let's bring this in. So you might have an Excel or a Google Drive or Google Sheet, sorry. Do it that way, but let's say you've exactly the same as you would have in your live trading log. So you might have let's assume you're trading Forex, the pair, or if it's stocks, then ticker symbol, whatever it is, stock symbol. Pair, stance, if it's long or short, entry, stop, target 1, target 2. And then you might have a note, time frame. You want to keep a log of what time frame that's on. That might be one thing that you want to track. Date as well might be something that you put. So the date was the 2nd of March, which for Americans is 3-2. For me, that's 2-3. But anyway, 2nd of March, the pair was the euro US dollar going short. The entry would be 1.1212. The stop loss would be 1.1233 plus 2 plus 5. And then you might work out exactly what your target 1. I'm not going to do this exactly. You would do this properly. Work out what your target 1 would be. I'm just going to say it's this. And your target 2 might be this, whatever. And then you would just have an outcome. Did that win or lose? Did you cancel it? So all you do is you play it out. Let's assume that's your trade up here. Play it out. By the time price ever came back to it, or did it ever come back to it? We're now still on the 2nd. No, we're now getting into the 3rd of March. 3rd of March, where was the EMA? EMA just underneath this now. So would I have cancelled the trade maybe? Let's assume you cancel the trade. And you just put cancelled. And whatever other notes or snapshots that you want to put to back that up. Time frame again, let's say this is a 1 day, 55 minutes. All you're doing is you're logging the trades as you would as if you placed them now, but you would have placed them in the past. And instead of waiting, so in this case, we use smaller time frames, but we started on the 1st of March. We've now finished on the 3rd of March. We've placed the trade and cancelled it in that period of time. But rather than in real life, placing a trade and waiting 2 days to realize, or day 1, nothing to do. Day 2, place a trade. Day 3, realize that it's no longer viable and cancel it. 3 days. That took 8 minutes. And I was explaining it as I went. So in real life, as you backtest, maybe 1 minute, 2 minutes. To find out the same answer. To learn the same lesson. If you go through this and you realize 90% of your trades are cancelled, again, why would you waste months to find that out? Find it out in a matter of hours. Gather that data. Go, wow, okay, 90% of my trades are cancelled. Maybe I need to switch out the timeframes that I'm using, or maybe I need to use a different EMA, or maybe I need to whatever. And then test that and see. Rather than wait for 6 months in real life to find out that 90% of your trades get cancelled, to then go, okay, well, let me try this, whatever it is, to make that different, and wait another 6 months to see if that works. Waste a whole year, or in some cases on the bigger time frames that you're trading on, years and years before you find out the answer, before you find out what could help you. So we've looked at Forex, we've looked at stocks, we've looked at TradingView, and we've looked at Top. So let's now look at futures. And again, you might want to use on futures, and I'm using obvious ones. But you might want to use with futures the continuous chart, or you might want to go back and look at the specific contracts. Either way, I'm going to use the continuous for now. And I'm going to assume that we are looking now at a 4 hour. 4 minute, there might be 240 minute. Okay, so we've got a 240 on the left, and so potentially we're looking at a 21 on the right. So again, we've looked at different time frames, we've looked at different markets, same thing, right? We're doing the same thing. We're just going back in time to a certain area. So let's say ES, you want to day trade it. Now, obviously, the smaller the time frames, the more specific you need to be, because if there are trades that happen in the past as you go through this data that would have been executed at 2 a.m., unless you're trading at 2 a.m., those trades are irrelevant. They don't go in your log because you wouldn't be trading them. So only log the trades that you would actually be placing. So in this case, because we're on smaller time frames, let me go even smaller. So let's assume that you have a 60-minute on the left and an 8-minute on the right. Okay, so even smaller. Let's go back. Same thing, the rewind button. Let's go back to here. So this was the start of October, right? So let's just do that for argument's sake. And we're going to just load some more bars and give it a sec to, there you go. Brilliant. So I think we're already back in time there. Oh, no, we're not. So let's go back even further if we can. Let's go to, this was random, end of September. So again, let's just say this is a month's worth for this. And again, if you're trading only one thing, if you're only trading the ES, then you'd kind of get an idea of how many trades do I place in a day? How many days do I trade a week? Therefore, how many weeks worth or days worth do I need to get 100 trades? Let's say just on the ES, you're placing 10 trades a month. Well, you either need 10 months of that, or maybe you're also trading the NQ, maybe you're trading oil, gas, cattle, orange juice, whatever. And maybe on each of them, you do 10 a month. And there's 5 of them, in which case you only need 2 months worth because you've got 50 trades per month across 5 different markets, 5 different assets. Times 2 months gives you 100 trades. Point is, work out how many trades or how much time gives you 100 trades worth. Absolute minimum. Again, if you can get thousands worth, if you can be diligent enough and give your business this time, this training time, to give it thousands of trades worth, even better. And again, thousands of trades worth in real life might take you years. In backtesting, it might take you a few weeks of an hour a day, every day, backtesting for 6 weeks. And you learn what 10 years worth of trading would have done for you. Same learning in such a shorter amount of time. So with the time we've got left here, so let's say we've gone back to this time. Let's unsquish it again. So this is what we would have seen 1 a.m. Would we be trading at 1 a.m.? Probably not. So let's bring this up. I can't remember if this is in my local time or not, but just for argument's sake, let's assume it's in US time. So let's say I'm trading as the markets open. So this is what I would have seen at close of play at 8 a.m. on the 27th of September. Now let's assume I'm trading between 8 a.m. and 10 a.m. Making that up, right? Let's assume that's your window. Only look at the data within that window. No point looking at data from a period of time that you're not trading in. Makes no sense, right? So we want to go back to the 27th of September here too. Again, we can maybe try and squish that a bit more to get there quicker. So go back to the 27th of September. Getting there. here we are. So 27th of September, we're going to click our little rewind and find 27th of September at 8 a.m. or just as that market's open. Well, 8:30 it would be, but let's assume you're doing your analysis now. So if you're looking at that then you'd be going, okay, so that's at the close of that hour. This is at the start of that hour. So you're looking at it going, okay, at that period of time, we had a thick blue dot, probability was up, the EMA was at 3708, but there's no UFOs there. So over the course of that hour, middle of that hourly candle, no UFOs lining up, nothing. Keep going. We're now into the 9-hour candle or the 9 a.m. candle. So we just do that on the other side as well. By 9 a.m., our auto climate has become unconfirmed, so we don't trade. Rather than waste 2 hours of real time finding that out, you learn in seconds that there would have been nothing to do that day on the ES between those hours that you would actually be sat there looking at it. Okay, so I realize that for some people, if you're very new to trading at all, this can be scary. By the way, to get out of backtesting mode or training mode on top, you just click the furthest symbol to the right and it will take you back to wherever we are in real time. And there you go. You can go back to current time. Okay, so I realize that when we are new to trading, we've just learned what a stock really is, what it means to trade stocks, or what futures are. Never heard of it before. Maybe we've just learned about it, or we've just learned what risk management is. And now I'm saying you could test this, you could test that, and you can click here and you click here and you go back to here and you do this and you just play it out and you learn. And I get that that can be overwhelming. The more you can understand about backtesting, the sooner into your trading journey, the better. Trust me. It took me years before I gave backtesting the time of day, and it wasted years of my life in relation to my trading knowledge, because I had to go through real years, and in my case, real money in the markets I was trading, to learn lessons that I could have learnt when I was 23 rather than 28 or 27, whatever. You can use backtesting as a way to literally save yourself years, to realize sooner that, oh, actually, if I'd have done this, if I'd have done that, that would have worked out better for me. But although I would have made more money, I'd have to be wrong less often or wrong more often. Am I actually okay with that? Or should I try something here that maybe makes me right more often and just see, as long as I'm profitable, is that still okay? Let me test that. Rather than go through real life of really losing or really making money sometimes and then losing, because you don't have the data to back up that you might often go through 4, 5, 6, 10 losers in a row, but then you go through 4, 5, 6, 10 winners in a row. Without data on your strategy, you don't know that. You're just losing. It feels horrible. If you have data that tells you that's normal, that will happen sometimes, makes you feel better about it. It's also something that helps us to be able to understand that when we are applying different strategies and we're going through it in real life, that if we have, so let's say 10 losers in a row, if our data tells us across 5 years you'd never had more than 5 losers in a row, and in real life you're experiencing 10 losers in a row, that's where you go, okay, something's off. But you know that because it's based on data, not based on your personal tolerance as to where that number should be. Your personal tolerance as to where that number should be, the amount of losers in a row, should be something that you apply to your trade plan and your backtesting to therefore execute a strategy that fits within that boundary and gives you a framework to know what's working and what's not. So the sooner you can understand backtesting and use it, trust me, you save yourself years of learning. You get to profitability way quicker. You learn so much more. It's just, I think you can tell I'm quite a fan of backtesting. It's just the best thing you can do as far as I'm concerned as a trader. Okay, so I realize I've gone on, so I will shut up now. You will see tradewithufos.com/Becky there on the bottom. Again, you can go here. If I find it there, you can go to, if I put that up, tradewithufos.com/Becky. You can go to that link to check out apps, courses, coaching, one-on-one coaching, live session notes from the trades I'm placing in my sessions, see what's happening there. You can come to the bottom and you can find a Q&A session or section that can help you. You've also got my email address, becky@tradective.com, which will help you. If you email me, if you have any questions, just email me. I'm happy to help you. Or you can place it on the Q&A section. So have a good rest of your weekend, whatever's left of it. Enjoy trading, enjoy backtesting, make it fun, make it something that can really allow you the time to really try different things and figure out what works out best for you so that you can apply something that you're way more comfortable with, you'll make way more confident in, and that you can execute consistently. I'll see you next time. Take care. Bye-bye.